Thank you, Don. And the next panel, we're back to economic thinking. So I'm Kathleen Stephansen, Senior Advisor to the Boston Consulting Group, and also the Vice Chair of Programming for the GIC. And I'm here to introduce our next panelists. We have first, if you look at your program, we have Philippe Waechter, and he is Head of Economic Research at Ostrom Asset Management, which was recently renamed from Natixis Asset Management, which in 2003 was renamed from Banque Populaire Asset Management, which was renamed from, in 1998, from Banque Populaire. So here we have Philippe, who has sat at his desk and has had multiple different employers, it seems. So please come and join us. The second panelist, Isabelle Job-Bazille. She is Chief Economist of Crédit Agricole, and that's since 2013. Prior to that, she was in 2000, I believe, she joined from Paribas, and she was there an economist. When she joined the Crédit Agricole, she joined as an economist specializing in Japan and Asia in general, and it's since 2013 that you are chief economist. So please join us again. And the third panelist is David Berson. He's chief economist of Nationwide and holds a doctorate from Michigan University. Prior to joining Nationwide, he was chief economist and strategist at the PMI Group. And prior to that, David was chief economist of Fannie Mae and also Wharton Econometrics. Prior to that, I believe that he did hold a couple of positions in government, at the Federal Reserve Bank and at the Treasury Department, and also had a stint in academia. So, David? So each one of you will be talking for about 7 to 10 minutes, I believe, and then we open it to questions. Philippe, do you want to start? Thank you.
Hello, thank you for your invitation. The world in 10 minutes, I will try. 6 or 7 remarks on the global environment. First, we have had a very strong recovery in 2017, and my guess is that it comes from a very positive policy mix, specifically on monetary side. We have had almost everywhere some very accommodative monetary policies, and it was a real source of improvement last year. And the point is that this year, without new impulse, new stimulus, we cannot expect a stronger economic environment, except maybe in the US, but we will discuss that a little later. But that's why in Europe, we cannot expect stronger figures than what we've seen in 2017. We have had, as François Villeroy-Gallo said that this morning, we had 2.5% last year. We will have 2.4% this year, not very different. And for France, it was 2% last year. It will be close to 2% this year. So no more acceleration due to the lack of stimulus. The other general remark I wanted to do is to say that when we look at the back to 5 to 10 years from now, we have the perception that the environment at this time was more coordinated, more cooperative than what we currently see. In the US, we've seen that your new president is not as cooperative as former presidents could be. We've seen Brexit, we've seen something in Hungary, in Poland, and more recently in Italy. And the point is that none of them really wants to have a coordinated and cooperative policy that could hurt world trade, as which could be important because the recovery we've seen in 2017 was linked with a strong recovery in world trade. So that's something we have to be very attentive to, because we've seen in 2008 that trade could collapse very rapidly, so that's something we have to be very attentive to. So this is two global remarks. One on the Eurozone. We are currently in a pretty good environment, even if the first quarter was a little weaker than expected. For a single reason, make a very simple calculus. I did that for France just because it's a simple one. We have had 2% growth in 2017. We expect 2% growth this year. When you make a very simple calculation, what quarterly growth do we need to have for this number for 2018? It's just 0.4%. It's not 0.6 or 0.7 we have had in the last part of 2017. So this period was clearly not sustainable, and we are searching the real trajectory for the Eurozone, and I think that the ECB will help us to do that. I don't think that the ECB, and François Villeroy-de-Galhau this morning was very smooth, I would say, on his comments. He doesn't want to hurt investors or companies with a rapid change in monetary policy. Monetary policy in Europe is just a source of support for internal and private demand. So it will continue, and that's why we can expect a strong environment. What is interesting is that we have, just on Europe, we have 8.5 unemployment rate, and the equilibrium unemployment rate calculated by the European Commission is at 8.4%. But we have no inflation even if these rates are close. This means that probably the unemployment rate in Europe is much lower than what we currently see and what we currently expect. So we still have room for improvement, and the ECB can maintain its very accommodative monetary policy for long. Just a word on Italy, because that's something that worries us a lot. You've heard that Lega and the five-star movement has a commitment to make a government in Italy. I don't know what will happen. Lega is from the north, and one part of the program is supposed to exit the south of Italy, which is a very costly part for Italy, very low productivity, and most of voters for the five-star movement come from the south. How will it be manageable? I don't know. And if you look at this morning, they said we have 3 agreements on our program: a flat tax at 15%, a lower retirement age, and a welfare revenue, meaning that universal income. You can have income whatever your situation. And we don't know how this will be sustainable and how this environment will be manageable for Italy inside the Eurozone. François Villeroy-de-Galhau may have an answer for what could be the ECB behavior on that, but currently that's a real issue for all of us, because Italy is the third largest country in Europe. So have that in mind. decline. So that's something we have to think about. The second remark I wanted to do is on the US. I don't know how things will go in the US for a very simple reason. We have a very low unemployment rate, 3.9%, probably very close to full employment. We have still very accommodative monetary policy and now a very accommodative fiscal policy. In other words, the policy mix is what we usually see in a recession. So what will happen? How things could be managed? I think that the Fed will have to increase its rates more rapidly than expected. The last dot graph from the March meetings of the FOMC said 3 hikes this year. Probably it will be more than that, just to avoid large disequilibrium in the US economy. The consequence of that is that probably the yield curve will flatten this year and next year, and this will lead the economy into recession. The other point we currently see is that this environment, this change in expectation on what can be done by the Federal Reserve, is that the dollar is much higher than what we saw in recent weeks. It's something important for the US for sure, but it's very important also for emerging markets. We've seen capital outflows, we've seen an enlargement of yield spread for emerging bonds, and so this is a very complicated story now for emerging countries. We know that when the Fed really increased its interest rates, we have this capital inflows, and it's always damaging for emerging markets. Probably we are in such a situation now, so the rules of the game for emerging countries have dramatically changed. The last 2 points in a nutshell is to say that we are still very negative on Brexit. A very simple calculus is interesting. When you look at the trend, the GDP trend from 2013, start of the recovery in the UK, to the second quarter of 2016, where the referendum on Brexit took place, and you extended this trend to now, and you do that for the UK, you do that for France, because for both of them we have the first quarter data on GDP. You see that France is above the trend by 1.5%. It's the recovery I mentioned before. UK is 2% below the trend. So it has a real cost now for people in the UK. And the last point I wanted to mention is that in Europe we are very concerned by the decision that has been made on Iran, because all European companies will have to are dependent on the dollar market, and so if they do not follow the instruction given by the White House on their activity in Iran, they will no longer being able to have a real activity, because all these companies are international companies. So if you have the dollar is the main currency for everything, for borrowing, for trade, we will have to comply with this sanction, and it could hurt the European economy. So that's something we have to think about. Excuse me. So I've made my 7 points, 7 remarks on the world economic outlook. So we're still positive, but there is a lot of clouds from the US, from Italy, from Iran, from different plans, from Brexit. We have to be very attentive, and 2017 was a very easy year compared to what we will have this year. Thank you.
about to introduce you, but please go ahead.
Thank you, Kathleen. You have tried. Hello, everyone. So I will focus my speech on Europe and not because in 10 minutes it's so difficult to have this round, this global picture. And just to begin, I think that we all agree at the global level that there are grounds for optimism. The growth has become broad-based and concerns now both emerging markets and advanced economy. Inflation is contained in almost everywhere, and even if there has been a shift from the paradigm of cheap money, monetary and financial conditions remain quite supportive for growth. If you look at Europe, we are still in a classical economic recovery with a positive feedback loop between job creation, income generation, and consumption, all of which encourage firms to invest and to hire, creating new jobs, and so on. So this virtuous cycle is at play. The recovery has become more self-sustaining. Its momentum does not depend anymore of supportive external factors, as was the case at the beginning of the recovery, where there was a major contribution of low oil prices, weak euro, and also, of course, historically low interest rates. And we truly believe that this recovery is likely to continue quite some time, because there are no endogenous reasons, no homegrown reasons to stop this virtual cycle. And having said that, and you have already mentioned the fact that probably the acceleration phase is behind us, the cycle has maybe, we don't know yet because you have a lot of debate about it, but maybe the cycle has already reached its peak in Europe, as suggested by some data, and especially the high level of capacity utilization in some countries, and also labor shortage. So there is still a great debate about the level of potential growth, the state of the output gap at present. But anyway, probably, as I said, we are going to have the growth is going to make a sort of deceleration, a slow deceleration in the coming 2 years, even if growth is expected to be above 2%. So it's not a cliff at all. It's just the question of a moderation of growth and going towards what we call the potential. And so as the economy recovers, and I hope I'm not going to contradict Mr. Governor, there is no longer monetary emergency, and so we are entering a cycle of monetary normalization, but there is no threat from inflation pressure. The monetary support could be withdrawn very gradually. And if you come back to inflation, we have very low inflation rate in Europe, and probably the Philippe's curve will continue to be flattish with no upward pressures on wage. And just because we have still disinflationary forces at play, I would mention only two things, the two usual suspects. I would say first globalization and the all-out search for competitiveness that will continue to put downward pressures on prices and wages, and also the digitization with the development of a new form of work, highly flexible, low-paid jobs that will continue to put a lead on the wage increase. And but anyway, even if we have low inflation, the ECB, and I suppose that Mr. Governor said this morning, that the ECB is still convinced that even if the transmission times have lengthened, they are convinced that in the end the cycle will eventually lead to its inflation mark, and that's why ECB will behave cautiously but will not stop, will continue its normalization process by ending QE most likely by the end of the year. In our forecast, rates are not expected to be increased by mid-2019 because we believe that the ECB needs before to assess the impact of QE phase-out and to see its impact on growth, and also to let the cycle drive up a little bit inflation towards its target. And in any case, the ECB is still committed to maintaining a very accommodative monetary and monetary policy in order to support the current economic recovery, and also to avoid any shock on interest rates. The still convalescent European economies, of course, could not absorb such a shock coming from the tightening, undesirable tightening of financing conditions. Of course, many risks surround this scenario, this benign, I would say, this benign scenario. We have already talked and mentioned the resurgence of protectionism, the risk of trade war and its potential impact on international trade and the global growth outlook. We already mentioned in our speech the international disorder with the rising tension, especially in Middle East, with potential impact on oil price. And I a little bit disagree with what have been said before, but because we are still concerned about financial stability. A long period of very low interest rates have encouraged risk-taking and lead to asset price inflation, and even some overvaluation in a number of markets, according to us. And we think that a brutal reassessment of risk could lead to a severe correction of the markets with collateral damage on growth and at the global level. But to finish, because I think it's of paramount importance, it's to speak about this political risk in Europe. And we talk about Italy, but more generally, I would say that the rise of Eurosceptic and nationalist parties in a number of European countries show that the deep-rooted problem that fuel populism are not over. And meaning that we have a deep social malaise in some countries. And how to explain this social malaise? Several reasons. I will mention certain of these reasons. The first one, given the severity and the protracted nature of the crisis, it is hardly surprising that a part of the population, especially in countries that has most suffered of the financial crisis, to have the feeling that they are left behind. If you look at these, I would say, the left-wing parties that emerge in the crisis, Podemos in Spain, Syriza in Greece, and we talk about five-star movements in Italy, they are the byproducts of the crisis. They attract voters by rejecting the harsh austerity measures imposed by Brussels and by proposing alternative recipe, very attractive alternative recipe, or very generous and often unreasonable social measures. So you have this question of economic at the center of this social malaise, but we have also globalization, jobs destruction, but also this global wage arbitrage that will continue to put, as I said, a lead on a wage increase and is probably responsible of the income stagnation of the working and middle class income, and also rising inequality. We talk about digitization with the feeling that the feeling that you are increasing job insecurity with the new form of jobs, as I said, highly flexible, low-paid jobs, and the risk with digitization is probably to have a growing polarization in the labor market between skilled and unskilled workers, and in the middle, intermediate job that could be, in the future, automated, could be hollowed out, and this fuels the fear of a drop in status, especially for middle class. So it's another reason why we have this social malaise. And I will end with the migrant crisis, of course, that in Europe that has exacerbated the feeling of being under threat, and with people turning a sort of nostalgic sense of identity supported by the narratives of these populist parties. So how we counter this polarization in our societies that make us, I would say, more vulnerable to violence, how we can navigate in this world in disorder when our conviction is that strength lies in unity. And you will understand my conclusion that rather than having a divided and rich Europe, we need more Europe. Maybe it's just a wishful thinking, but anyway, we have a unique window of opportunity to reform Europe, to make it stronger and better. So I stop here just with this message of hope regarding Europe. Thank you very much.
Thank you. Thank you so much. David, do you want to lead us on, and then we'll have the Q&A. Thank you.
Good afternoon. I'd like to thank GIC and the Banque de France for hosting us for this interesting conference. As the very last speaker, it's always difficult to say things that are different from what other people said, but I'll try. So my remarks will be concentrated on the outlook for the U.S. economy. I'm going to talk about short-term, intermediate term, and long-term. So we'll divide this into three parts. Something that hasn't been said is, one, the IMF in its latest World Economic Outlook stated that virtually every country in the world, and by virtually we can eliminate North Korea and Sudan and Venezuela, is in expansion. And this is the first time since before the Great Recession began. Second, the U.S. economy is now in its second longest expansion ever, past the expansion of the 1960s. And if we get through June of next year, in the U.S., it will be the longest economic expansion ever, and I'll talk in a couple of minutes about why I think that is almost certain to occur. So economic growth this year started out a little more weakly than we closed last year, but a little stronger than we thought it was going to be, with real GDP growth at only 2.4%. It's highly likely that we have seen residual seasonality still in the data, slowing first quarter growth over the rest of the year. It doesn't change growth for the year as a whole, it simply changes where it will be. Most estimates for growth this year in the U.S. are around 3%, some a little less, some a little more. We haven't seen 3% annual growth again since before the Great Recession. Growth was already picking up some last year, and now we have expansionary fiscal policy. Certainly the increase in government spending from the budget, but also the tax cuts. The tax cuts we can divide between Keynesian demand-side impacts and potential supply-side impacts. But the supply-side impacts, if they are indeed present at all, are a long-term impact. They don't really affect the economy in the short run. They affect the economy in the long run as you get perhaps increased labor force participation, but hopefully more business fixed investment, greater productivity growth, lower inflation potential in the economy. But again, that's a long-term impact. So the near-term impact of the tax cuts is Keynesian demand side, and added with the stronger growth we saw last year, I think will easily push us to 3% growth for the year. Unemployment, has been stated, is already at the lowest level since the 1990s at 3.9%. If we grow at 3% this year, it's highly likely that we'll see the unemployment rate fall to levels that we haven't seen for generations, probably to around the levels that we saw in the 1960s, 3.5%, perhaps a tad less. If that doesn't generate wage pressures, I don't know what will. Perhaps nothing will at that point. But with 3.5%, perhaps lower unemployment rate, I think we will start to see more wage pressures generated. With relatively weak productivity growth, those wage pressures should more easily translate into price gains. Certainly in periods of strong productivity growth, faster wages do not necessarily mean higher inflation. But in periods of slower productivity growth, the translation to faster prices is easier made. And so I think we will see a modest pickup and a continuation of that modest pickup in inflation that we've already seen, pushing the inflation indices that the Fed most closely watches, both the overall and core price indices for the personal consumption expenditure deflator, up on a sustained basis above 2%. Probably not much above 2%, but on a sustained basis over 2, and with a rising trajectory, suggesting that the 3 to 4 Fed tightening moves for this year, we've seen one already, is likely to continue. Our best guess is that we'll see 4 if inflation in fact does move above 2% on a sustained basis. Neatly, probably once each quarter in the last meeting of the quarter. That makes it really easy for forecasters. So if you could pass that on, please. It makes it really easy for us. Thank you, Dave. Next year, fiscal policy will continue to be stimulative. There's always a lag on the impact on spending in the economy from tax cuts, from spending increases, but we'll also have higher interest rates. So while we think growth will continue to be above trend in 2019, higher rates, and we think rates will be even higher in 2019 than this year. Again, probably 3 to 4 25 basis point moves by the Fed if inflation keeps going up, if growth is above trend, probably bringing growth down to about 2.5%. But that is still above an approximately 2%, maybe slightly lower trend rate of growth. Recall I said that we needed to get through June of next year to have this be the longest expansion ever. Well, if we have 3% growth this year and 2.5 next year, we'll easily get past June of next year to make this the longest expansion in U.S. history. How will this expansion end? All the expansions in the modern economic era, which I will define as being since 1913, all but 2, and those came about after major wars when the U.S. economy was retooling to a civilian economy from a military one, have been caused by significant tightening by the monetary authority. in reaction to higher inflation. And you typically get an inverted yield curve. I think we will eventually get an inverted yield curve as inflation moves up, as the Fed tightens, as long rates will not rise as much as short rates. A flat yield curve doesn't do it. Historically, you need a fully inverted yield curve for more than several months in order to presage a recession. And I think, again, that's what you'll need. It seems unlikely we'll get that in the next year, probably not even in the next 2 years will we get a full inversion of the yield curve. But whenever we get it, while it may signal a recession to follow, at no time when we've had an inverted yield curve did a recession occur sooner than a year after the yield curve inverted, and typically it's somewhere 1 to 2 years. So if, let's say at the earliest, the yield curve inverts, let's say at the end of next year, the end of 2019, that would suggest that the earliest we would get the next downturn in the U.S. would be the end of 2020, perhaps as long as the end of 2021, and the yield curve may not even invert that soon. So I think this is going to be a very long expansion indeed, much longer than the longest one ever. Probably lasting at least another 3 years, perhaps another 4, and hopefully longer than that. If, in fact, inflation doesn't rise meaningfully, and we don't know precisely why it hasn't, perhaps the causes that have kept inflation down will continue. I don't think that will be the case, but it could be. Then the Fed will not have to tighten as much, and is less likely that in any near-term period, meaning in the next 2 to 3 years, we would see that yield curve invert, and perhaps the expansion could go on for quite a bit longer. But more likely, we'll see at least a modest pickup in inflation, more Fed tightening than the market expects now, and ultimately that yield curve inversion. Now, longer term, tax cuts, expansionary policy from the Monetary Authority doesn't stop recessions from occurring. The business cycle has not been repealed. We'll get that next recession. It will be a severe one? Well, hopefully not. It's hard to know the shape of the next downturn today if it is at least a couple of years out. We don't appear to have the imbalances, particularly in the housing and mortgage markets in the U.S., that we had in 2007. Hopefully those imbalances won't appear in important sectors between now and the time we have the next downturn. So it is likely that the next downturn, rather than being another great recession, will be another run-of-the-mill recession, something much less than we saw in 2008 and 2009. The important thing here is that long-term growth is determined not by the shape of the business cycle, but by what happens with long-term labor force growth and what happens with productivity growth. Both have been fairly weak in the U.S., hence 2% growth or slightly more on average over the course of this expansion, compared with slightly more than 3% growth in the period back to the end of World War II. And that's caused by both slower productivity growth and slowing labor force growth. Going forward, can we get back to 3% growth? We'd certainly like to have 3% growth as opposed to 2% growth. 2% growth, because of the magic of compounding, means that generation from now, 2 generations from now, wealth in the U.S. will be significantly less than it would have been if we'd had 3% growth. How do you get to 3% growth? Well, you have 2 levers. You have productivity growth, and we've attempted to hit that lever with the tax cuts. Again, the tax cuts, if they do have a supply-side impact, you won't see that in the near term. Increases in business investment take a while to get started. They don't respond immediately to tax changes. And then the impact on productivity growth would likely take a while as well. The size of the corporate tax cuts, though, suggests that, at least in our work, the most we think we could get with productivity gains would be about a 0.5 percentage point per year over the long run. So if, in fact, productivity growth well, while it's averaged 1%, most economists think it will perhaps edge up to 1.5%. Maybe we'll get to 2% productivity growth. I think that's probably the fastest we could go with what we've done with policy thus far. But the bigger problem is on labor force. The tax cuts will do very little for labor force participation because most of them were directed on the business side. And I think the evidence is much greater for supply-side impacts on business investment spending than supply-side impacts of tax cuts on individuals coming into the labor force. How do you change what is now the inexorable slowdown in labor force growth in the U.S. and Europe and Russia and China and Japan, most of the industrialized world? Well, at least in the U.S., you can do it through smart immigration. Well, unfortunately, we're moving the other direction. And that could be changed. It may be changed. It may require some years before that is changed. But I think we know what to do there, but we haven't done it. So if we look farther out, if labor force growth averages, at least for a while, say 0.5 percentage point, and productivity growth is 1.5 to 2 percentage points, then we could see growth in the U.S. over the long run averaging 2 to 2.5%, a tad faster than what we've seen over the expansion, but not as fast as we're seeing now. It would require significantly more work on productivity enhancing tax cuts and changes in immigration policy to really boost growth in the U.S. back toward 3%. It's possible, given labor force dynamics, you can't really get back to 3% because you just can't get there on the labor force side. But if you get to 2.5 to 3, that's substantially faster than what most analysts think we are headed for right now. So with that, I will stop and we'll do questions. Thank you.
Thank you so much, David. So, given my role as a moderator, very selfishly, I will usurp the first questions to each one of you. And starting with you, Philippe, you mentioned that there were no real coordinated policies within certainly the Eurozone, Brexit, and to some extent also with the US. So are you surprised about the fact that the markets have had a fairly tame reaction to these events? So that's the question for you. And for you, Isabelle, you mentioned that the recovery will continue, and one of the factors, despite the risks that we're seeing, is the fact there's no endogenous factor that might tip it over. How do you view the regulatory framework, and particularly MiFID and other, the encadrement, the regulatory framework here, and to what extent is this a hindrance to the recovery at some point in time? And David, you mentioned wage pressures, potentially, although I think you might have, to some extent, answered the question, but wage pressure increasing, translating to higher inflation and a more aggressive Fed. But to what extent, given the fact that we are not seeing much of it, and this could be, in fact, a very welcome development, in that it finally gives pricing power to corporations. So now you have corporations having cash from the tax cut. You have pricing power coming into place, lengthening, if you will, the corporate profit cycle. So perhaps...
I would start. I think that the change is to a less coordinated, less cooperative world. You said maybe market has not perceived that, but I'm not sure that financial markets are able to perceive all this change. Probably they will see that after, but not before. And so we are still in a changing environment. When we were at the beginning of the 80s, we have had a large change on on political side, with Reagan in the US, with Margaret Thatcher in UK, with François Mitterrand, Helmut Kohl. All these new on this political scene, all these new people on the political scene have changed the world. Clearly, the globalization has started with them, but we have perceived this change with lags. I think we are at something which is not very different from this, with Donald Trump, who is not a pro of globalization. Brexit is just to say we can do it by ourselves. With Hungary, with Italy, they all say we can do it by ourselves, as Isabelle mentioned it. And so we are just witnessing this environment, this new environment, but we don't know exactly what will happen. What will be the consequences of the trade war, if there is a trade war? What would be the consequences of what has happened with Iran? Will it create a new conflict in the Middle East or not? We are not able to say that. So when you are on financial market, you just look and imagine that it will not change too much. When it had changed, you say, okay, it was what we could expect, but it was too late. It's too late, and so this is it's the same perception that what is mentioned in a recent book from McAfee and Bjorn Nielsen, very complicated name from MIT, who said people who are much involved in new technology are not able to clearly see what will happen with this new technology. And this bias is seen on technology, is also seen on financial markets.
I wasn't sure if it was mine.
Me too. Regarding your question on regulation, it's not easy to answer. I would say that the deregulation was partly responsible of the financial crisis. It wasn't the only cause, but it was part of the reason why we have this crisis. And the regulation was implemented in order to make banks and the financial system stronger, in order to help to avoid another crisis, of course, and to avoid the building up of financial imbalances. And as you said, maybe at the cost of less credit increase, but if you look at what's happening now in Europe, we have a recovery in credit in many countries, so it is not at the moment an impediment for growth. But I would say that in the end is to find the right balance between regulation, deregulation, in order to let the financial sectors being supportive for growth, but not endanger the financial stability.
Thank you.
Key with what's going to happen with wages and inflation is productivity growth. Without productivity growth, it's very hard to get real wage growth. You can get nominal wage growth, but it's hard to get real wage growth. The translation isn't perfect, but if you look at compensation per hour, and if that goes up without an increase in productivity growth, you get an increase in unit labor costs. And companies will tend to pass that along. If we get productivity gains, and perhaps all this investment will give us some even outside of the tax cuts. So perhaps we'll see some faster productivity growth. in the next year or so anyway. That gives companies the wherewithal to give wage gains without passing them on in the form of prices and without having to cut profit margins. And that's the key. If all that happens is wages go up, no productivity gains, companies raise prices, there's no change in profit margins there. If they don't raise prices, in fact, their profit margins will go down. If they could raise prices by more than that, they would do it now.
Thank you. So I guess it's time to open up, yes, question to the audience. And Chris?
In this panel and previous panels, I've heard people talk about long-term interest rates rising. And, the view we have in my little firm is that the holdings of central banks, which are very large, are not hedged. There's no selling pressure on those securities. They're completely out of the market. So given that, and given the duration, lacking for private investors, how do we say that we expect, for example, Philippe said he expects the 10-year to go up faster than short-term rates. When the Fed and the central banks in Europe and Japan have suppressed short-term rates for so long, I think it's the opposite.
I do not think that long-term rates will go up. As the governor said this morning, we will stop flows, but stock are important. And I think that in the US we will have a flattening of the yield curve through the short part of the curve, but the long part will not move. And I think that in Europe, interest rates, which are low, if you refer to Germany or to France, they will remain quite low. I don't expect, first, I don't expect a strong change in inflation expectations, so that's the reason why I do not expect a change on long-term rates, and the adjustment will be done by central banks, and in the short term only by the Federal Reserve, and so that's specific to the U.S. We will still have a very steep yield curve in Europe. When you look at Germany or France, we have a steep yield curve, and it will not change rapidly. But the long-term rates will not move too much from the level they are now.
Well, precisely, but earlier it was suggested that they could have used swaps instead of buying securities. And I think that goes to the crux of the issue, because nobody hedges these positions. There's no selling. So they just sit there. And all of that volume is away from the market. So the big banks, they don't have the trading volume, etc. And that's why I think it could be very difficult to get long-term rates to rise.
Absolutely.
And yes, our conviction is too that we won't have an increase in long-term interest rate. But look, the situation. For example, the global debt is higher than it was at the peak of the boom, before the crisis. And the only way to make sustainable this level of debt is to have growth or inflation, nominal growth, but we know perfectly well, and you talk about productivity and demographic issues, that probably in the coming years, nominal growth will remain moderate. So the only way to make your debt sustainable is to maintain very low interest rates. And you are right, central banks will continue to control the long end of the curve if necessary, and we have also other structural factors such as the fact that we have a large pool of saving at a global level coming from European countries, and United States a little bit less, but in European countries, because we are an aging population, and so we save for our retirement. We have a lot of saving coming from emerging markets, and especially China, because they save for everything, and this large pool of saving is putting, of course, by a question of demand and supply, a downward pressure or lead on long-term interest rates.
Chris, there's up and then there's up. I mean, the 10-year has more than doubled in 2 years in yield. I don't expect it to double in the next year or two, but I do expect it to go up. Inflation expectations have been well anchored, but inflation will probably go from about 1.5% to 2.5% over a year and a half. The Fed has clearly laid out a path for tightening, so there's an expectation of a rise in short-term rates. In addition to their selling longer-term debt, the federal government, we've mentioned this very much, is going to be selling a whole lot more debt into the market. So what happens to demand? Is there a perfectly elastic demand curve there so that prices won't change? I don't think so. I think that the market would like more longer duration, no-risk asset, hopefully no-risk asset. But I don't think it's perfectly elastic, and particularly once the ECB starts raising rates, very modestly, some of the demand that has been coming to U.S. Treasuries will translate to euro-denominated debt. And I think all of that gives us a reason to believe that long rates go up modestly. And, in 2 years, maybe up 100 basis points, that's pretty modest.
So the question on rates, specifically in the U.S., is what will be the consequences of the large deficit, public deficit, we will see for the 10 years from now. In the 10 years from now, the Congressional Budget Office said the public debt owned by public will peak in 2028 at the level it was when the U.S. exit from World War II. How can you interpret that? That's a type of question on which we do not have any answer. But it means that we all understand that we could have very large public debt after a war. But in peacetime,
Such a label.
what does it mean? What does it mean to have a 5% public deficit each year for the next 10 years? That's more problematic than inflation. It creates a situation when you look at you create a graph with unemployment rate and public deficit or public balance, you see that they both reflect the business cycle from the beginning of the 50s to now. It will be very different from this year and the next 10 years. So there is something that is very new in the US environment. And my question on the US is that until now, for sure, we have had a very long business cycle, as it was mentioned, with low growth. It's the worst business cycle we have had since World War II. But no large disequilibrium. We are entering a period with potentially large disequilibrium, and we don't know how we will be able to manage this situation, because at the difference from what we saw at the beginning of the 80s, after Reagan, we have had kind of same policy mix. At this time, the center of the world growth was in the US. It's no longer the case. So how will the balance be in coming 10 years?
Well,
I don't know.
Can I just say one thing? Of course, we're economists, including the economists at CBO, are not very good at forecasting. And among the worst things we are at forecasting is budget deficits, because we're not good at forecasting long-term growth, in large part because we're not good at forecasting productivity growth. I think that budget deficits will rise, but it is also possible that the business investment incentives in there will give maybe a little bit more growth than we think, and that caps what the debt to GDP ratio goes up to. So I'm not saying that the concerns are misplaced. They're not. But it's possible they won't be as serious as we think now.
I put a candle every morning for that.
So hold your thoughts, okay? Because then we can reconvene next year here and rediscuss this in a context that probably will be slightly different.
Yeah, for sure.
So unfortunately, we are, out of time. The other more optimistic way out would be to, in fact, adopt Mike's view that he doesn't care about debt. But he's too busy talking, so. So on this, I want to thank you all, and I think that we should invite Dawn back, but thank you very much for all these very interesting comments.
Let me close by thanking all of our panelists with us here today. I think we had a relatively optimistic conference. We talked about windows of opportunities. We talked about research and new tools and approaches on the monetary policy side. We talked about low and falling unemployment. We talked about normalization of policy. And we decided not to worry about debt. So that's pretty good. So this event works because we have great speakers, we have great panelists, but it also works because it's meant to start a conversation, and that's what should continue if we are successful. Please check out interdependence.org if you'd like to know more about GIC, and we look forward to seeing everyone in the future. Thank you.